There's a $2.2 trillion bubble ready to pop in the commercial real estate market. And how this affects the everyday person is the fact that the real estate crisis is a banking crisis, because 70% of this 2.2 trillion debt is held by our small and regional banks. And that debt is maturing by 2028, which is a shame because most people rely on the small and regional banks for small business lending, because they're the ones with the loan products that are most tailored to what you need. And so the banks and these property owners of these office spaces, retail spaces, etc., they have three very difficult decisions to make right now with these refinancing deadlines that are coming up. So the first decision is the owners will need to either pay their debt in full, or they'll need to refinance, which is the most common, and that's the maturing debt piece, which we'll get to in a second, or they'll have to default on their loan, which is the worst, and the worst is already happening. Look at this. The Securities and Exchange Commission is questioning some community and regional banks about their exposure to commercial real estate in their loan portfolios, as potential losses on the loans could spur them to further cut lending. You guys, long story short, if the commercial real estate space collapses our small and regional banks, what is that going to do to small business owners, aka small business owners and their families? I mean, look at this article. Chicago area commercial property sales down 44%. San Francisco office building sees 84% cut in value. This 32,000 square foot building is now valued at $8.2 million when it was previously valued at $52 million. And so the SEC has issued letters requesting banks to provide more details on their commercial real estate loans, as in they're asking questions like, how much of your portfolio is made up of hotels, offices, or multifamily? What are the loan to value ratios? What are the occupancy rates? And so think about this. These are actually great questions. Why are they doing this, especially now? First off, because of the recent Silicon Valley Bank collapse, which seems so long ago, but it's not. It just happened in 2023. And just a quick recall for you guys on what happened with that bank collapse. They were extremely concentrated on one industry as their customer base, and they were also super concentrated on their investment, because you guys know the money you give to your bank, they'll either lend it in other areas or they'll invest it to make profit. But once interest rates increased during, just a couple years ago, their business totally flipped on its head, so much to where they ended up having to sell $21 billion in long-term investments for an almost $2 billion loss because they needed the liquidity. And so I just want to emphasize that the Silicon Valley Bank, it was so heavily invested in one area, which is not normal. But regional and small banks are pretty heavily concentrated too. Think about this. They do one of four things: personal checking, small business lending, residential real estate, and commercial real estate. That's it. At a group of 27 smaller mid-sized banks, commercial real estate accounted for 44% of total loan portfolios. And then when you take a look at this chart, you guys, look at New York Community Bank has 71% of their total loans is commercial real estate. And so this is prime example. If their entire commercial loan portfolio blew up, what do you think is going to happen to them? And so this commercial real estate credit crunch is the fact that, yes, we have higher interest rates, but our bigger problem is the combination of the concentration of commercial real estate at our smaller banks. And then when you pair that with the fact that commercial real estate values have dropped significantly, like I shared at the beginning of this video, the fact that it's time to refinance debt, what you have is a disaster brewing. So keep in mind, when I keep saying this refinancing of debt, that commercial financing is totally different than residential, because, when you buy a house, you can do a 30-year fixed interest rate loan, and if you never want to change it, you can just go about your business for the next 30 years. But when you buy an office space, a retail building, a commercial building of some sort, and you do a commercial loan, those loans have terms 5-10 years, and many times those loans are interest only with a balloon payment due at the maturity date, which is when the final payment is due. So if we're seeing an upwards of a 40% drop in major cities like New York, Boston, San Francisco, and let's say in 2019 you purchased an office building for $7 million, took a loan on it, and your monthly payments were manageable, but now your same building is only worth $4 million. Now you're underwater. How do you refinance a loan when you're underwater? How does that make sense? And so being underwater is a thing right now. Falling commercial property values are raising solvency risk for potentially hundreds of banks. About 14% of all commercial real estate loans and 44% of loans on office buildings appear to be in negative equity, meaning the debt is now greater than the property value. This is a lot that's going on, and this is not to, I'm consider myself an optimistic person. This is not for fear mongering. This is informational purposes on what's really coming down the pipeline. And I will say, hopefully positive changes can come sooner rather than later, because the only way I see how we can mitigate this banking crisis is, number one, interest rates need to come down to help a few people with something. But at the same time, a lower interest rate is not going to help you if your property values are just in the complete trash. But, if maybe your property values remain flat or at least in the same ballpark, you have a little bit of hope, okay? Number two is for property values need to come back up, which can happen one of two ways. The first way to bring property values back up is, you guys have seen this all over the news. It's driving me crazy, actually. More and more companies are mandating for employees to return to the office, which brings people back into the city, brings business back into those areas, and decreases vacancies, which leads to higher rent rolls, and that leads to higher property values. But, leave remote people alone, because the other way to increase property values is to convert that office space to residential living, which makes way more sense, because you guys, we have a housing issue, an affordability crisis, and, but with that, the caveat, with converting buildings, now you have to deal with policies, now you have to deal with zoning, and you guys, that's a whole nother video. So that's what I have for today's video. What do you think is going to happen with the remote work? What do you think is going to happen with these office spaces? What do you think is going to happen with these banks? How do you feel about this imminent real estate crash? I 100% do not believe a residential real estate crash is coming because of the supply and demand issue. But when you apply the supply and demand issue on the commercial space, nobody wants offices. So you guys, don't forget that I am a residential lender lending in 48 states. If you guys know anyone who would like to purchase a home or pull cash out, whether that's full doc or no income doc, let me know. My information is in the description below. And until next time,